Well, I think that we're nearer the end of this bull market than we are closer to the beginning. But I still think there are a number of things that would signal that this bull market has at least another 12 months of good stock market returns, mostly in the way of good economic growth and solid corporate profits. And this is all supported by still very easy monetary policy, although it is getting a bit tighter, and a massive fiscal stimulus package that I think will continue to benefit companies with lower corporate taxes, less regulation, and increased government spending.
And Steve, on a day where the S&P 500 is hitting a new record high, where do you think stocks go from here, especially as the Fed does shift away from easy money to a more tightened environment?
Well, this market was born of very aggressive monetary policy, not only here, but also worldwide, the Bank of Japan and the ECB. And it is starting to change. There was a story today about how the Bank of Japan is less reticent. They purchase ETFs. Their central bank actually goes to the market and buys ETFs, and it appears that that's slowing down. ECB, Mario Draghi's term is about up. He's probably going to be replaced with a relatively conservative German. That's going to change policy at the ECB. And the reason why I say that's important is the BOJ and the ECB have balance sheets that far outweigh the Fed. The Fed is the fourth largest balance sheet on the planet right now. So my view is if monetary policy slows down, so will this market. Although, even slowing down, it continues to be fairly aggressive, so I don't think you'll see stocks plunge. It just will kind of ease off and maybe trend sideways to down for a bit.
So, Steve, in light of that, if you see on a more global basis a shift towards tightening monetary policy, where do you want to be invested right now? Or do you want to take some off and have some cash?
Well, we still think yields are going to remain relatively low to history. Even though rates are moving up, they're going to be moving up from 2% to maybe 3.5% or 4%. And there are a long list of high-yielding equities that we think are inexpensive. They trade at single-digit multiples. They don't have a lot of growth, but they bring a lot of income to the table. You could put together a portfolio that yields 8, 9, 10% pretty easily right now, very diversified with a lot of very cheap names. We think that makes the most sense given where we are in the cycle.
So, Michael, if you Michael, if you think the bull may have another year to run, and I want to get ready for when it starts to stumble, what should I do?
Tyler, I think you should balance your portfolio between two competing forces. One, we're still in a kind of reasonable growth, low rate, low inflation environment. So I want sectors of the market that can generate very solid revenue growth and very solid earnings per share growth.
And they would be
technology and consumer discretionary. Now, Tyler, I want to balance that because we are getting the later stages of the economic cycle. And Dominic just went through a number of things, the credit cycle, the housing market, that would signal we're at the later stages. So I'd also want to invest in things that benefit from higher input cost, building inflationary pressures. Those would be energy, materials, and industrials.
Steve, where do you see the 10-year yield ending the year?
I still think that policy is very aggressive out there. I don't see the 10-year getting above 3%. I've been writing about this for weeks now. I think the 10-year is going to stay below 3% for the rest of the year, unless there's a significant change in policy at the ECB or the BOJ. That liquidity washes up on our shores. The 10-year competes with government bonds from Europe and Japan. I don't see yields moving up a lot unless there's a significant change in policy. This backing off from the pedal a little bit that we've seen recently is not going to move the needle that much. So I think 2.8, 2.9 is baked into the cake for quite a while unless there's changes.